The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very good morning to you. Welcome to Squawk Box Europe. I'm Juliana Tattlebaum here with Carolyn Roth this morning, and these are your headlines. The White House keeps up the pressure on Fed Chair Jerome Powell, but markets appear unflustered, with the S&P 500 closing at a fresh record high. Treasury Secretary Scott Bessent tells CNBC they want to probe the Fed's decision-making.
We should think, has the organization succeeded in its mission? I think this idea of them not being able to break out of a certain mindset, all these PhDs over there, I don't know what they do.
The European Union is reportedly preparing a range of so-called nuclear options against the U.S. should the two sides fail to strike a tariff deal before President Trump's looming August 1st deadline. AstraZeneca says it will invest some $50 billion into the U.S. over the next 5 years as the British drug maker looks to expand manufacturing and R&D stateside in anticipation of potential pharma tariffs.
Well, Carolyn, I don't know about you, but one of the most interesting interviews I thought of yesterday was Scott Bessent, and we gave a little teaser in the headlines there around him calling for a review of the Federal Reserve, saying he thinks that is appropriate. You would do the same if you were looking at the FAA, for example. You'd assess whether they were fulfilling their mission. And he basically said that should be the case with the Fed as well. And it wasn't the only thing Scott Bessent weighed in on. He also weighed in this interview with our colleague stateside around President Trump's push for low interest rates, suggesting that a decrease in interest rates would unlock the mortgage market and potentially be a positive for the U.S. economy. And we know that Scott Bessent is seen as one of the only adults in the room. Many would say that in the Trump administration. So fascinating to hear him weigh in on one of the most controversial debates in the market right now.
I think you're absolutely right. And of course, that was a wide-ranging interview our colleagues in the States did yesterday. But of course, remember, Juliana, he has an audience of one, and that is Donald Trump. I'm sure he's been watching CNBC and he's been watching that interview as well. And we know whenever Bessent speaks, he's listening as well. Of course, he's also trying to counter the criticism when it comes to that Wall Street Journal article saying that, well, this is how any administration would work. We weigh in with our advice, and then the president ultimately makes the final decision. But I think that's a very important piece that you have to keep in mind. Who is he talking to? He's talking to Trump. All right, let's move on. Treasury Secretary Scott Bessent, of course, has called for a review of the entire Fed. Speaking to CNBC, Bessent added to criticism of the central bank's policy stance.
We should think, has the organization succeeded in its mission? If this were the FAA and we were having this many mistakes, we would go back and look at why has this happened? I mean, look at as you said at the top of this broadcast, there was fear mongering over tariffs, and thus far we have seen very little, if any, inflation. We've had great inflation numbers. So, I think this idea of them not being able to break out of a certain mindset, all these PhDs over there, I don't know what they do.
And we'll get a take on the Fed from Janet Yellen later today after the former Fed chair and Treasury Secretary wrote an op-ed alongside Ben Bernanke calling on policymakers to protect the central bank's independence. Don't miss that first on CNBC Conversation at 1 p.m. London time. And we will be hearing exclusively from Fed Vice Chair and potential Powell successor, Michelle Baumann, later today. Don't miss that conversation at 12:30 London time.
Meantime, the EU is reportedly mulling a broader set of countermeasures against the U.S. ahead of President Trump's August tariff deadline. That's according to Reuters, citing diplomats as hopes fade that the bloc will be able to secure a lower 10% tariff from the U.S. The outlet says that a growing number of bloc members are eyeing anti-coercion measures, which would allow the EU to hit trade in U.S. services, access to public tenders, and financial markets. Public procurement alone in the EU is worth around 2 trillion euros a year. Now, last week, Commission President Ursula von der Leyen said the bloc is not there yet, but a French official told Politico that European negotiators must make it clear they're ready to press the red button if the EU can't secure an acceptable deal. U.S. Treasury Secretary Scott Bessent told CNBC that implementing high levies from the 1st of August will put more pressure on those countries to come up with better agreements, suggesting the U.S. is leaning toward using the threat of tariffs as a negotiating tactic in order to bend other countries' positions. Bessent gave CNBC the broad strokes of current negotiations Monday.
It doesn't have to get ugly. It's the nature of a negotiation. There's a lot of back and forth, but I will tell you, as you know, I'm not an economist, I'm an economic historian, and that the nature of deals like this is that we are the deficit country, so the surplus country will always feel it more. We have a gigantic trade deficit with the EU, and so with the level of tariffs, it will affect them more. So I would imagine that they would want to negotiate faster. They got out of the blocks in a slow pace. They've become more engaged. But as I've said many times, it's 27 different countries, and then you have the EU sitting up on top. So you have this supranational organization negotiating, and I do think that some of the underlying national governments are frustrated by the pace, but again, it's an EU negotiation, not a country-by-country negotiation.
Let's welcome David Rees to the program, head of global economics at Schroders. David, it's great to have you back. Looking forward to getting your take on things here. Let me kick off with the latest on tariffs. We just had Scott Bessent there speaking to our U.S. colleagues yesterday, saying he thinks this August 1st deadline, which the administration insists is a deadline this time, is going to push countries to act faster, EU included. Do you think that's the right take? A little overly optimistic? Because on the other hand, we could see an August 1st deadline push them to just go ahead with these countermeasures.
Yeah, well, I think we saw Trump say that it's not 100% a deadline already, didn't we? So, yeah, let's see. I mean, they are clearly trying to put a squeeze on to get these tariffs done. If you look at what's been threatened so far, and it's really difficult to know what's going to be carved out, what's not going to be carved out. But on paper, they could really lift the tariff rate significantly higher than certainly we were assuming, something over 20%. So not all the way up to the Liberation Day threats, but quite a significant increase. That's clearly not something markets are banking on, right? I think they're assuming that this is going to get pushed out or watered down.
So would you say that markets are complacent at the moment? Is it just about the taco trade? They think ultimately he is going to back down?
I suspect it probably is. Look, we've been quite upbeat on the US economy. We've been thinking the economy is solid, that growth is going to be going at a decent clip. But if you try and work out what's priced in terms of growth over the next year or so, it seems as though certainly the equity markets, they see a GDP growth of over 2% over the next year or so. And if you really get in these tariffs up over 20%, I think that's probably optimistic. So it would seem that the market is assuming that they're going to back out.
But there's plenty of reason to be optimistic when it comes to the U.S. economy,
Yes.
at least, and how they're weathering a potential impact. I mean, take a look at the consumer. We had the consumer confidence numbers based on the University of Michigan indicators. They're up again. Yeah. Inflation expectations are down, which is quite surprising. And then you've got the corporates who are reporting numbers, and they're able to spread out the cost of tariffs. So there is good reason to think that the U.S. economy can take any tariffs in stride, right? Or no?
Yeah, I'm not sure.
Optimistic?
Look, we've been very bullish on the US economy for the pure reason that the labour market is solid and your average employee is getting real wage growth of 1.5%, 2%, and that's a pretty good starting point for a consumer that is willing to spend. I think probably we haven't seen the full impact of tariffs yet. If you actually look at the effective tariff rate, we're all talking about potential tariffs in the future being a lot higher. So far, it's about 8-9%. So we haven't felt that full impact yet. So the inflation is still quite muted. The kind of shock and awe through sentiment surveys is winding down a bit. But probably there's a bit of pain to come in terms of tariffs and inflation. But we don't think that's going to derail the US economy. But let's not get over our skis, I think, over-optimistic.
But let me ask you, what's the lag effect here? Because back in 2018, 2019, we saw, for example, CapEx spending was only coming down maybe a year later after the tariffs were announced. So what can we expect this time around?
I think that's really difficult. I think there's quite a bit of trial and error to go. I mean, if you look at the amount of trade that was front-loaded first half of the year, the fact that the tariff rate hasn't increased all that much, it's going to take probably another 3-6 months before we feel the full effect of these tariffs coming through once they're actually on. And then you sort of overlay that against quite strong demand. So we do assume that inflation is going to pick up because of tariffs. But I have to admit that so far it has been a bit slower than we thought it would be, which is a good outcome ultimately.
It does seem like a better outcome than most economists were expecting, but clearly the delays have had a role as well. The fact that we haven't seen the tariffs implemented on the time frame that was initially set out. Let me turn back to Scott Bessent's comments on rates, because I thought it was really interesting to hear him weigh in on the benefits of lower rates here. Clearly, we have to contextualize this, that his name has been put out there as a potential successor to Jay Powell. But he said yesterday that if we lower interest rates, it could unlock the mortgage market. And we had a really interesting guest on from Deutsche Bank earlier in the week, or last week rather, who pointed out that the majority of property in the U.S. is owned outside the top 10% in terms of wealth percentile, whilst the bulk of equity holdings are concentrated in the top 10%, i.e. for Trump supporters who are increasingly lower income Americans, the mortgage market is the most important thing to them. And what are your thoughts on that and the idea that lower rates could be a positive for the U.S. because of the impact on mortgage rates?
Well, they certainly could be in terms of getting activity going through the economy. You need the 10-year to come down significantly lower, right, because we're pricing off the bond market. We need yields to be significantly lower to get real activity going in the housing market, because obviously a lot of people are locked into very low interest rates. So if you bring down long-term interest rates, then yes, you can get the housing market going. The issue is if you're bringing long-term interest rates down when the economy's hot, it's going to get hotter, and ultimately you're going to end up having to put rates up again. So I think we've got to be a little bit careful about trying to depress rates too much into an economy that's already pretty strong.
Not as simple as that.
Yeah.
So what happens to the U.S. economy ultimately? No chance of a recession, or is there a 20-30% chance of that, or is it just mainly stagflationary risk?
Yeah, look, we are positive on the economy, and in terms of the nuts and bolts of the private sector and consumer balance sheet, we don't really see much chance of recession there. The big risk would be that all of this uncertainty makes consumers save money instead of spend. But if they haven't done that yet, then it seems unlikely that they're going to in the near term, because we're fiddling around the edges of tariffs now. So I think really, in terms of recession rate, it is quite low. What we don't know is what the next kind of wild card in terms of policy might be that could cause a shock of retrenchment. I think for me, that's where the risks are.
And what would you say are the possibilities in terms of those wild card risks, if you can predict?
Yeah, who knows? I mean, it doesn't seem like trade policy is going to do the trick, right? So probably that's not the cause of recession. I mean, could you get some kind of bond vigilante type scenario ripping through the bond market because of the state of the public finances, and if they then try and depress rates? Maybe that's something, because that's where the big imbalances are, and maybe that's the kind of source of the next problem. But again, it seems like we're a ways off from that.
And lastly, in terms of Jay Powell's thinking here, to what extent do you think his reticence to lower interest rates is a function of having got it wrong coming out of the pandemic, the fact that he thought inflation was going to prove temporary and it actually was a lot more intense and long-lasting than he had predicted?
Yeah, I am always a big fan of thinking about the behaviour of central bankers and why they don't want to be pillared for the recent mistake that they made, right? That's something we saw post-GFC. They didn't want to put rates up and snuff out the economy when people were worried about deflation. Hence, they were a bit slow out the blocks with inflation around COVID. Probably you've got the reverse going on now. But again, I mean, would you really want to be cutting interest rates when you're not certain about what's going to happen to inflation, or whilst growth is strong and whilst markets are quite buoyant? Probably not, right? You'd stand back and just wait and see if things are really going to get worse or not.
Well, Waller made the point that the private labor market isn't strong enough, is it?
I think it is. I mean, should we be seeing blockbuster growth in terms of employment when you've got the unemployment rate at quite low levels? The economy's been firing for quite a while. You should be getting close or around full employment, so you shouldn't expect blockbuster jobs growth, right? You've still got the unemployment rate quite low. So I think when you look at the initial claims and wage growth and the kind of leading indicators, things look okay, right? I mean, Warren's picked up a bit, but it's not that bad. The labour market looks okay.
David, you always make everything sound so easy and sensible, but I know it's not, but thank you for making it easy for us to digest. David Rees, head of global economics at Schroders.
All right, quick check of the U.S. market action overnight, and we did see a record high both for the NASDAQ and the S&P. Take a look at this. The NASDAQ up by 0.4%, the S&P also eking out a modest gain of 0.3%. Alphabet did really well ahead of its earnings later on Wednesday. We also get numbers from Tesla. Today we get the report card from GM out of Detroit. Let's take a quick check of the Asian trading session, and I do want to point out that the Nikkei 2-5 opened up after it was closed for a public holiday yesterday, and this was its first chance to react to the upper house loss for the LDP. Initially it was higher but fell back at the close of trade, off by almost 0.3% in the final hour of trades. Quick check on European futures as well. This is how we're setting up. We saw the markets ending fractionally lower in yesterday's trading session. The FTSE 100 this morning seen off by 0.2%. Similar percentage decline seen for the CAC 40 and the DAX. Plenty of earnings on deck in this week's trade as well. Now, still coming up on the show, Japanese markets return to trade after upper house elections saw Prime Minister Ishiba's ruling coalition lose its majority. Plus, we'll take a deep dive into the fate of Europe's auto sector this earnings season ahead of another key release from Volkswagen later this week, and a narrow sales miss for Givaudan in the first half. We'll dig into the numbers with the CEO, Gilles André, right after this break. Let's get to some corporate earnings this morning. Givaudan posting sales of 3.9 billion Swiss francs in the first half of the year, up just over 6% on a currency-adjusted basis, but narrowly below analyst expectations. The company said it is implementing price increases to fully compensate for higher costs, including from tariffs. I'm glad we're now joined by Gilles André, who's the CEO of Givaudan. Thank you so much for joining us this morning. I'm taking a look at the pre-market indications for your stock, seen down by roughly 1% pre-market. That said, also some analyst coverage showing some very good commentary that you showed impressive improvement in North America. So to you, how do the numbers stack up in the first half, Gilles?
Well, we started very strongly in the first quarter, and we continue to do so in the second one. We have to consider that last year we had a very high comparable at the end of the first half of 2024 with more than 12%. So we are growing 6.3% on top of that. So I feel really good about those numbers.
Obviously, there's a big Swiss franc impact here on your numbers, but if you look under the hood in terms of the performance of fragrances versus flavors, how are you feeling about that also when it comes to the regional diversification?
Yeah, obviously, we have two divisions. One is the fragrance and beauty, and the other one is taste and well-being, which are really half and half. And the fragrance and beauty is continuing on the strong momentum. The difference to taste is that fragrance and beauty is enjoying a big momentum, which has been going on for now the last 5 years with fine fragrances, which account for 20-25% of the fragrance division. And the perfumes market and the perfumes for us are growing at a double-digit rate over the last 5 years. So that creates a very strong support of the division. But on the other side, taste and well-being, we are very happy with the performance. We are growing 4.1% again against a strong comparable, but there we are growing twice as fast as any of our big competitors. So the market overall in flavors is slightly slower because you don't have fine fragrances in taste. So that we are quite happy about the performance. And looking at the regional split, as you know, we like to say that Givaudan has sort of natural hedges, so meaning that we are everywhere in the 4 and the 5 regions, actually, if I include what we call SAMEA, the Middle East and Africa. We saw a very encouraging sequential improvement in North America. We saw a very good continuation of the growth in SAMEA, which now accounts for basically 20% of the group. And so basically having those different dynamics, and I include there Europe, which is also surprisingly, given the economic environment, also growing strongly for us. So all those things sort of play out to give those very consistent results half year to half year or year end to year end.
Gilles, thank you for the color. Let me just dig in a little bit more in terms of what you're seeing in the U.S. especially. Are you seeing the weakness that some of your customers are seeing?
Well, actually, it's a good comment because, I mean, first, overall, we are growing faster than most of our global clients. And in the US, let's see, what our clients are publishing in terms of numbers. But what we have seen is a sequential improvement. The first quarter in North America, we were flat, and in the second quarter, we are plus 4%. So this is quite encouraging. And it's supported by, as you know, the different categories of products that we sell across, from perfumes, fine fragrances, all the way to taste and food. What we also see in North America is quite interesting because everybody talks about, let's say, the effects of GLP-1. It's true that a number of Americans take the GLP-1 route. So actually, that obviously you could argue it has an impact on the overall food consumption. But on the other hand, we see a lot of new projects, new breeds, what we call new breeds, which are essentially new flavors or natural ingredients to actually develop complementary offerings to go alongside of the sort of GLP-1. So I'm talking there hydration, proteins, health and wellness. All of those things are also a great complement.
Well, let me continue down that stream of talking. The Make America Healthy Again movement, somewhat linked to what you were just talking about there. This is the movement fueled by RFK Jr. When do you expect to see the benefits from reformulation in food and greater innovation by some of your CPG customers?
Yeah, we start to see some of that, because as you know, we are also in the sort of the natural colors. We actually took a very intended strategic direction a few years back when acquiring Naturex, which would put us, adding a whole portfolio of natural ingredients, not only for colors, but also for natural preservatives or natural flavors overall. So that helps a lot in the transition to sort of what we call clean label food. So we start to see some of that, especially on the color side. On the color side, we are very, very well positioned, with two colors which are quite important being replaced in the future, which is the blue and the red, with entirely new natural offerings. So that's for us quite positive.
Gilles, let me ask you about the elephant in the room, and that is U.S. tariffs and how they're impacting customers around the world. Now, you said before that you have natural hedges in place, but I do wonder to what extent you can, tariff-proof your business. Clearly, you've got the ability to raise prices across the board, but how are you feeling about the environment ahead?
So in the first half, obviously, we have seen very little, let's say, impact of tariffs because they were sort of, as you know, in works. And as we look going forward, we certainly will have tariffs to be added on top of our invoicing. So part of the pricing, and we'll do that in a very transparent way with our clients. As you know, whatever we sell in the US, we make in the US. So the only things where we have to apply tariffs are on the ingredients that we have to buy, especially all those natural ingredients which grow in the various parts of the world. So those ingredients have to be applied with the tariffs and back to the client. So and this is really in works, and certainly will happen in the second half.
Okay, so last time, Gilles, we talked about your dogs. We talked about potential investment in pets. I'm not going to ask you about your dogs today, though I do hope that they're fine during these hot summer months. But I do want to ask you about M&A. I saw that you recently did some M&A activity or involved in that in Latin America. Where are you looking for bolt-on acquisitions?
Yeah, so thank you for asking for my dogs. They are fine, Karen. So Pet food, we are, if there would be an asset in pet food, we'd be happy to try to buy it. But we are developing offerings around pet food, around flavors, but around palatants, through innovation. So that's going to take a little while, but we'll slowly, build up this business. We acquired another one in terms of bolt-on acquisition, which is really interesting. On top of the fragrances, the regular beauty fragrances, and also the skincare, the active ingredients that actually do the job in skincare products. We bought at the end of last year a makeup company in Italy, which actually places for the future Givaudan in the third part of beauty, which is makeup. If you take perfumes, skincare, and makeup, that was really the third leg, and we'll slowly build around that. And as you mentioned rightly, we acquired a small or took majority involvements in Brazil, which is a fragrance and beauty competitor. And this is really part of the strategy of Givaudan, which is around the bolt-on acquisitions to also buy small competitors, which give us a very nice and interesting portfolio of clients that we don't necessarily have. And the two combined with Givaudan is a great way to grow. So we have done that, a number of times over the last few years, and bolt-on acquisitions around competitors is very helpful.
Gilles, lastly, guidance for the second half of the year. What can you tell us about what we can expect?
Well, our comparables will not get easier. What we have said is that we have obviously 2025 is the last year of our 5-year cycle, so guiding 4 to 5%, but we already are way above that. Today was 7.4% at the end of 2024, so that's why we say we're going to be at a higher growth than 4 to 5% for the average. But we remain very confident for the second half. Again, comparables will not get easier, but we are a very well hedged business across clients, geographies, and segments.